Hi, hello everyone. I'm coming back, and are you ready to start the second part, or we can still wait for another 3 minutes if you need a break?
I'm good.
Okay. All right, so in this part, we are talking about auditing the revenue and receivables, of course, including the cash receipts part. So last week, we have discussed the control procedures and also how to understanding the business for the sales cycle. So I hope those are still in your mind. And also, we know revenue, the sales cycle, for most of the for-profit companies, this cycle is always important. Just recall what we got from last week. So for the sales cycle, what was the procedures for us to start when we want to audit the sales cycle accounts? So the first thing usually we need to do is we need to understand the business, right? So understand the business in the sales cycle, that means you need to understand the key sales procedures in the sales cycle. Different procedures, who are the main department involved in this cycle? Who are the authorized persons? How do they delegate the authority? What type of transaction documents are important? How will they do the control? And so how can they do the segregation of duties? And then how do they finally account the sales in accounting books? So here, understanding the control will be important because it's relevant to your assessed control risk, and also it's relevant to the decided audit strategy. Because when the control risk is assessed as high, then you probably need to focus on the substantive audit procedures. But if the assessed control risk is low or not very high, you could take consideration of the company's internal control, doing some test controls, and at the same time, reduce the level of substantive testing procedures, right? And then after that, of course, you can do your detailed test of controls and then substantive test. And all of them are about the sales cycle. So here I just extracted some tables from Telstra's annual report, 2008 annual report. So on this page, we are talking about the income statement items. So you got the sales revenue, total revenue, other income, total income. On the right-hand side, we also got the components for incomes, which includes revenue and other income. So from this table, what have you identified? Are everything okay for you, or are there anything you think you need to pay more attention to? So from my analysis to this page, I feel, well, okay, so if we are looking at these companies, Telstra's income, it seems they have majority of the revenue are from services, right? So consider their core business. So it's quite reasonable to me. So it is okay. I have no question mark on that. They also got sales of goods, because we understand in their business, actually sometimes they also provide those associated goods to support the service. They also have some construction contracts, but the percentage is not very high. So the overall composition of the sales revenue seems okay to me. Okay, and then what about the other revenue? So the other revenue, in 2017, they got $103 million. But in 2018, it has been jumped to $3 million. So compared to the total income, it's not very big jump, but for this account itself, the jump has been 3 times. So as an auditor, I would ask, so why? What happened to get such a great increase in other revenues? What has been included in this other revenue? And I would get the explanation from management for that. Okay. And also the other thing the other decision I would get from this table is I would do a lot more tests on the service revenues. I would also focus on other revenues because this account seems to be quite, so I would want to discover what happened in this account. But for the construction contracts, sales of goods, they are stable, they are normal. So I still do some sample tests, but maybe I can do less tests on those parts, those components. Right? What about other income? That includes net gains on disposal of PPE, net gains on disposal of business investments, government grants, NBN disconnection fees, other income, etc. Do you have any concerns?
Yeah, I have some concern about the net gain or loss on disposal of business and investment because the change is too much, like from negative 2 to about positive 300.
Yeah. So from -2 to $300 million just in 1 year. So the change has been need attention. So of course we get the management explanation first, and then if it's not enough, we would like to investigate this account, right?
Yeah.
Yeah. And do you also have some special interest in any items here as an auditor?
What about other miscellaneous income? Like what?
Which one?
The auditor the other miscellaneous income, the last one.
Oh, okay. Why? Why would you want to discover that?
Like the auditor would want to know where it's coming from, because miscellaneous is vague. What makes up that amount, maybe?
Yes. So for this other miscellaneous income account, because it's, so what's included, what's excluded, and so what's a criteria of recognize those income is not very clear, it's very vague to everyone. So at least auditors need to identify what incomes is included and are they properly recognized or not, right? So this account also raise a little bit more attention. Okay.
I'd be interested from the NBN disconnection fee of what the impact of that, they're obviously getting paid for disconnection, but what that will have as an impact into the services revenue in future years and whether that's being disclosed in the notes.
Yeah, very good point. So NBN disconnection fees. So for me, it's also strange because so how comes you just get those disconnection fees as other incomes? What is the impact to the business? and also what's income, what is the impact to my total revenue, right? So very good. So apparently, so we got a few special attentions to those different components, but still, because of the size and magnitude of those accounts, our first primary focus is still about the service revenue, okay? And we realize in other components, there might be high risky misstatement. So we still need to discover them. Okay. In the second page, so we are talking about the sales cycle, but we move on to the balance sheet and to look at some detailed explanations to the balance sheet accounts for current assets, non-current assets, etc. Why?
Been a 15 to 20% reduction in trade receivables, which is probably substantial for an organisation of the size and maturity of Telstra.
So the trade receivable has, so which one, sorry?
Between 2017 and 2018, the trade receivables gone down from 3.6 to 3.1, which is
6 to 3.1 here, right?
So that's a for an organisation of Telstra's size, that's a substantial reduction.
So
and
how would you
maturity,
verify?
it's not a new business; it's a business that's been around 100 years. So you would expect that not to deviate that much.
Yeah. So actually, so for Telstra, it seems to be the monopoly business in Australia. How comes they got the sales or receivable actually lower compared to the last year? And also, if you notice this decrease in the trade receivables, what other accounts you would also have a look. So have you looked at the non-current receivables? They got increased. Is that right? So that probably means there are some receivables that should be current receivables, but they couldn't collect on time, and then now it has been converted into non-current. And I would also further discover here the sales. So the sales also has decreased, but the overall decrease in sales is not too much. So it's not in the same pace. So still, trade receivable seems to need a lot of attention. Okay. Any other attention from you? Any other focus?
Maybe focus on the amount owned by joint ventures, like
Ventures.
6.3.
Yep. So this might not be a high risky part, but at least we need to get the explanation to understand why. So the amounts owed by joint venture has disappeared this year, right?
Yeah.
Mm-hmm. So anything interesting in this part? So it seems to look at the gross accounts receivable and also the provision for doubtful debts.
They seem to be relatively in alignment, like 2017 to 2018, like your gross receivables and then the allowance. I don't know, as a provision, probably a little bit lower as a percentage relative to 2017, but it's not huge. It's 10% less in receivables and about 30% less in allowance for doubtful debt. So
okay, so here actually in terms of total, the bottom line amount looks like quite reasonable, corresponding to the receivables here, right? But on the other hand, we also notice, so for the short-term past dues, the ratio, the percentage is lower. The percentage of the percentage of allowance is comparable. But for the past due over 60 days, it seems the company now adopt a lower percentage for allowances. Is it right?
54 on 92 versus 77 on 138. What's that? It's about 60%. It seems about 60% in both cases.
Okay, so this one is in both cases is the same, but what about this? So 55 and 59 for past due 90 days and also 120 days.
Well, the allowances, like the allowance there is about 20% in like the 11 on the 55, 17 on 59 is like 30, well, not 30%, but 25%.
Yeah. So
it
seems they have
they're allowing a little bit less.
Yeah. And also, I think in the last table you mentioned, it calls your attention to the decreased trade receivables. Apparently for the companies, they do have the incentive to decrease the, no, not decrease, but sometimes they may have the incentive to reduce the amount for the trade receivables. So the information here actually, the information here actually would explain a little bit about the decreased amount for trade receivables. Is it right?
Well, they have the incentive not to make allowances for doubtful debts because obviously if they've got any bonus on NPAT or anything like that on an accounting basis, that would be impacted. So that is sometimes the reason why executives don't like doubtful debts or make the provision lower.
So here, actually, after we read those financial statement details, so we have got a lot of questions regarding the sales cycle and relevant accounts. By this time, we have a lot of questions, but we find some possible answers, but we have no definite answer, right? So that's why we need to do the audit test. Okay. So at that stage, what we do is understanding the financial statement and also understanding the business, right? So of course, we also need to understand the control. So suppose here we are, we want to audit a very small company. This is more audit client, which is let's say stationery factory with small amount of cash sales and also small amount of credit sales to the wholesalers. And in this audit, we know this company has a reasonable control system. And in our preliminary assessed control risk, which has been rated as medium, so we decided to do the lower assessed control risk approach. So in this audit, for the sales cycle, our preliminary conclusion was the control system on the sales is okay, it's reasonable. And then also, when we look at the risk assessment procedures, okay, we look at the management responsibility and the management incentives. We found actually the sales manager's bonus are linked to the sales numbers. We also look at the overall business environment and the supply chain information. We found this company, maybe the sales are actually relying a lot on a few very large customers. And also we know one of the major customer are at risk, close to bankrupt. We also look at economic situation here. For example, in this client, actually currently, all the business are in the very hard economic situation. When they further look at the control activities, so we look at the key controls of this company. How do they design? And also we consider in terms of the control, what are the assertions? Which assertions might be more important in the control of the sales cycle? We also look at the reliability of the information system, including the control system, including the monitoring and the control process. Okay, so by understanding and documents internal controls, we get the test of, we got the assessed control risk. We also look at the systematic test of controls, which will be focused on the control effectiveness and also focus on those key assertions for control risk. We also know we are going to use inquiry, inspection, observation, walkthrough, and if for complex issues, we are using reperformance activities to do the test controls. Okay, so coming back to the hypothetical company, the small stationery factory with cash sales, credit sales, with medium level of preliminary assessed control risk. So based on those limited information, if you are looking at the key controls, what counts could be the key controls? Sorry, which assertion would be the key assertions for the controls? A sales stationery factory with cash sales and credit sales to wholesalers. It's a smaller business, not very large. We also have preliminary assessed control risk, which was not very high. They got reasonable information system. But we also know, for example, sales manager has bonus linked to sales numbers. Also, the company are in a very hard economic situation, in the economic environment. We also know the company's sales rely on a few very large customers. One of the major customers are at risk. So for those very limited information still, what are the key accounts, key assertions in your mind within the sales cycle?
I think it's walkthrough.
Walkthrough. So
Yes.
walkthrough, that is one suggested audit procedures to walk through the transaction. For the key assertions, I think for the sales cycle, occurrence would be the key assertion for control. Valuation, in this case, will be the key assertions for control. So for this case, reasonable, they got reasonable control. They got reasonable IT system. But we know actually the sales managers bonus linked to sales number. We also know heavy reliance on a few large customers, in which one close to bankrupt. So in this situation, probably I think because the control risk is not very high, and also they got a good information system, I would think actually all the accounts are not at very high risk, but I would put special attention to a few things. So first, they have cash sales, right? For cash sales, that actually means, so they are receiving cash. So cash management would be important. They got the sales, the managers bonus linked to the sales numbers. So they have incentive to boost or overstate sales. So I would focus on existence or occurrence for sales. They relying heavily on a few large customers, and one of that is going to bankrupt. So the concern for me is, so this will have great impact on the sales number. So first, link to the previous points. So the company do have incentive actually to boost the sales. So still about existence and occurrence assertion. And more importantly, if they lose major customers, the company itself would also have a survival risk. So going concern would also be in my mind. Right? And also for sales. So valuation would always be a concern for us. Okay, so we are talking about cash later on. So here we just skip cash. So for the control on occurrence, control on valuation, and also control on going concern. So are we able to identify some key control points? First, occurrence. So I think we need to check the credit policy. So do the company has a good credit policy? So for occurrence assertion, what about the evidence of shipping? If there are for all sales. What are the key control points for existence, for occurrence assertion? So the other key control could be the company should have regular customer statements and need to follow up any outstanding ones. Okay. What about valuation? What are the normal controls for valuations? for valuation of sales. Are you still with me? So here we want to talk about the key controls. Because from the business, we think we have identified some key assertions in this cycle. So we want to, for those key assertions, we also want to link them to the key controls because we want to test if the controls on those assertions are good or not. We have identified occurrence, valuation, and also going concern as the key assertions. So for occurrence assertion, we say, okay, so some important control points would be the company should have a good credit policy and credit granting procedures. The company should have a good control in those underlying sales documents. The company should also have the good control over the customer statements. So similarly, what are the controls over the valuation assertion?
A good credit policy would also go into the valuation.
So credit policy is also something about the valuation. And still those underlying documents are important, right? But here for the valuation, maybe we check more about the pricing details, calculation of totals.
You'd look at calculations of doubtful debts to accounts receivable.
Mm-hmm. And what are the others you would also raise?
What about cutoff assertions? Would you carry them out?
Cut off. So yeah, cutoff assertion is, yes, cutoff assertion could also be important, but so cutoff assertion for sales and also purchase is a must-have procedures. So it actually serves to the occurrence and complete assertion as well. So here we didn't really highlight that because we need to do cutoff, but it serves for the assertions of occurrence, completeness, and also valuation. So, but cutoff procedures would also be important, right? That's cutoff procedures for auditing. So here we are talking about control procedure, controls. So do you think the customer statements and follow-up would also be important for valuation? In addition to those procedures which are identical from the occurrence assertion, what others would be also quite important?
Customer complaints could potentially go into valuation.
Okay, that's a fresh point. Why customer complaints?
Because obviously if there is a growing complaints with regards to products, it might not be showing in the financial numbers now, but it might show in the essentially increased expenses in the future associated to warranties or return of products and sales.
So maybe, okay, so especially for stationery, okay. Complaints could be also important. And valuation, when we talk about valuation, so I think there is very important control also about the provisions, right? Or the bad debts. This part of control would also be important. Is that right? So collectability. Is also you want to clearly analyze. And also the written off procedures would also be part of big important control you need to consider. So here, so if we analyze, if we identify occurrence, going valuation, and also going concern as the key risk factors, key things we need to consider. So we have drafted out those key control policies, right? And what about going concern? We haven't touched going concern. Sorry, just right here. So review of major customers. So their credit policy would be important, I think, right? And also regular review of collectability of accounts receivables. So still credit policy, and also the provision policies, right? So here we have summarized, we have identified the important controls. Why shall we focus on those important controls? Because those are the basis for us to design the test controls. When you design your test controls, what you want to do is to test those key control points, right? So, and probably we can convert them, convert the position of them. So finally, those would be the key controls you want to look at. Is it right? So for each of the key controls, if you know they are key controls, you can design the test control to see first, are those controls, control policies available there? And also, are those control policies properly implemented? So what is the final effect of the implementation of each control policies? So 3 things when you design your test of controls. So are the controls available? You check the policy. Are they applied? So you do the test. Are they effective? So you do the test to see they have done the control procedures. You also do the test on the dollar value or deviation counts to see the deviation and also the dollar value difference is within the threshold, right? Okay. So I hope you're still with me. All right?
Yes.
Okay. So now we have just did some revision about the previous procedures we covered from previous lectures, actually. Now we can move to the substantive test on the sales cycle. So when we are doing the sales cycle substantive test, we will have the assertions on balances and also on the transactions, right? So those are the assertions on transactions. Those are the assertions on account balances. So I'm not going to go through them very detailed, but would leave you some time to have a look at them. So for the assertions on transactions, occurrence, completeness, accuracy, cutoff, and classification presentations, something special is the cutoff, as raised by one parent here. By one friend. One friend here. So the cutoff test serves for the both assertions of occurrence and completeness, because cutoff test is to jump between different accounting period. So if you are focused on the post-period transactions, sales transactions, actually you are focused on the completeness assertion. If you are focused on the pre-period transactions, probably you are looking at the completeness assertions. If you are looking at the post-period sales transactions, actually you are looking at occurrence assertions. On the other hand, if we look at the cash receipts, so we are still doing the cutoff test. So if your focus is the pre-period cash receipts, only about the post-period cash receipts, this will give you indication of occurrence of the sales. So cutoff test is also very important and serves for both occurrence and complete assertion. And for the account balance assertions, we have existence, rights, obligation, completeness, valuation, classification, and also presentations. So for the common substantive audit procedures, concerning those relevant transaction and also the balance sheet assertions, usually the substantive procedures are starting from substantive analytic procedures, then go to confirmation, go to subsequent receipts review, cutoff test, and then test of sales transactions, and then also we are going to review the 8 trial balances. Let's have a look at them. So first, so that will be the analytic procedures. So actually, if you click the link, you will be leading to a document about how to audit the accounts receivables, and especially how to do the simple analytic procedures for the sales cycle. So what has been important in the analytic procedures, in particular for the sales? So the first thing would be, so compare. See if I have the documents here or not. Sorry, I don't have that. I'll to show you the documents. Okay. Okay. So the first thing is, when we are doing the analytic procedures for the sales cycle, the first thing for us usually to do is to compare the day sales outstanding to the amounts for the from the prior years. Because if the company's core business didn't really change a lot, so those day sales outstanding usually also should be stable. So if there's a big change, you need to pay attention to why there's change that indicates fundamental changes, big changes in the sales pattern. Another important ratio, number or ratio we need to look at is the current ratio. Because in the current ratio, if the current ratio over different years has changed, so these would indicate maybe the company has has changed their accounts receivable policies or changed to inventory or accounts payable policies. So all of them may have impact to the current ratio and often is relevant to the sales numbers. You need also do a analysis to the ending balance of the expense accounts across 3 or 5 years. Because the sales number would also include so because the expense accounts might also be relevant to the overall sales and also the sales, the expenses or cost of sales in the sales cycle. For example, the payment to the employees, some changes in the payroll system, etc. So the relevant expense accounts should also be reviewed as a part of the sales. Very importantly, we need to review the policies regarding the bad debts, including the bad debt expenses occurred for the year across different years, and also including the overall allowances, the provision balance for the accounts receivable accounts. So if the trend is stable, it should be fine. But if the ratio has changed a lot, as we noticed for Telstra, of course, you need to investigate why. And actually in our slides, we just summarize more detailed analytical procedures for accounts receivable test. So by doing that, what we want to emphasize is when you are doing the analytical procedures, you should not just focus on the overall amount. You should also look at different product line and also look at different segments or different locations. When you compare your analytic procedure results, you should compare with previous years and also compare with the industry benchmark, as you notice from your assignments. So to identify the competitor or identify the industry benchmark might not be very easy in a lot of cases. But if you can clearly cut the revenue for different product line or different segments, this comparison would be more reasonable. So combining those two parts of information, so first, there are some ratios you need to focus on, some numbers you need to compare. Second, those comparison is not just about the overall ratio or numbers, should also be about by product, by segments, or by location. So when we are doing the audit, So when we are doing the audit, there are some simple procedures we can do. So first, we have done this part. So first, we need to keep in mind, when we audit the revenue, so we need to get persuasive evidence of arrangement exists. So we have the persuasive evidence for the major contracts, major customers, and major credit policies. We also need to get evidence on different stages of this sales cycle. So from the initial purchase order to the ordering process, to invoices, and also to the shipping, to the cash collection. So, and also to the later on provision calculation. The whole process should get some evidence. And also, we need to focus on the sales price. And also, we need to ensure the collectability has been audited. So when we're doing that, that means so the whole audit, the whole revenue cycle has been properly covered. And also, when we are auditing the revenue cycle, along with revenues, we should also, of course, look at the accounts receivables. That's why we look at the transactions for sales, transactions for cash receipts, and also we look at accounts receivable and cash balance at the same time. And we should also look at, focus on the confirmation of accounts receivables. As we mentioned before, for the audit data for accounts receivable balance, the most powerful documents for us to check is the confirmation documents. But in addition to the confirmation documents, those are also the necessary procedures for us to follow. So we need to first trace the receivable reports to the general ledger. In this way, to ensure so the total amount of the receivables have been recorded for the completeness purpose. We also need to calculate the receivables on the account, so on the receivable report, and then match to the accounts receivable total. In this way, we are checking the mathematical accuracy. If there's something outstanding, not matching between the receiving report, the receivable report, and accounts receivable accounts, or from the calculation, if the calculation of add up is not consistent with the totals, of course, you are going to investigate the outstanding numbers. So on the other hand, for occurrence assertion, we're doing the vouching procedures to test the sales transaction documents listed in the receivable reports. So basically, these serve for the existence and completeness assertion. Existence and also occurrence assertion for the sales and accounts receivable. One more important thing is for sales, recognition of sales is always important. So for us, matching the invoices to the shipping documents, especially matching the shipping dates and the invoice date, is very, very important and necessary. Okay. So build on that. So on top of that, so we use the strongest confirmation documents because external confirmation documents seem to be the strongest documents for the existence and evaluation to accounts receivables. I'm sorry, I think I'm going to, so it's 8 o'clock already. So are you happy to, we still record these parts until I think we have about still 10 minutes to complete everything? Or you want to stop now and we go to the presentations?
Yes, just continue.
Okay, yeah, thank you. And so all of you agree to continue?
Yes.
Okay, thank you so much. Right. So for the confirmation documents, apparently it's the strongest documents for accounts receivable accounts, right? For accounts receivable balance, because it's externally generated, externally circulated. It is a very independent document. So the question here is, how would you ensure these independent documents is really independent? So I think for the confirmation documents, it's important, which is issued by the auditor, not touched by the company's management, posted by the auditor, and then also received by the auditor, issued by the auditor. So, and also dealt with by the auditor without any condemnation of the management means the management wouldn't have any opportunity to manipulate those confirmation documents. Some famous examples of manipulated confirmation is, I think in one company, I couldn't record the name, but so the management provides the customer's details to the auditors, and then the auditor send out the confirmations to those listed customers. And then they receive very good responding rate from those listed important customers. So auditors take off this confirmation. And then after the year end, auditors, it was discovered actually those provided details are fake details. So auditors sending out the confirmation by themselves, but to the address controlled by the company. So actually company receives the confirmation documents, the company fill in the details and then sending back to the auditor. So in this process, auditors apparently has been tricked. So the beauty of these confirmation documents, because it is independent, but auditors need to ensure you need to maintain the independence in all the stages. For the assertion, so the confirmation documents can serve for multiple assertions, like existence, because if the customer didn't recognize these accounts receivable, you would doubt about existence of these accounts receivable. Of course, also linked to the rights. Also, completeness, because when you ask the customers to confirm their accounts receivable, they might fill in the amount. If the claimed amount from the customer is higher than what you know in this company, so you may doubt also about the completeness of accounts receivable, right? And all of them would also be about valuation assertion as well. So it's a very strong documents for us to do. In practice, there will be positive confirmation documents or the negative confirmation documents. Positive documents request customers to write down whether they agree with the amounts. And so no matter they agree or disagree, they need to send back their confirmation documents to you. But for negative confirmation, the customers are only asked to reply when they disagree with the amount showing in the confirmation documents. So in this sense, of course, the positive confirmation documents will be more powerful. Is it right? Because for the negative case, so if the customer don't respond, so you will need to doubt, do they disagree or actually they don't want to respond? So you get less information from negative confirmation. So auditors prefer to use the positive confirmation to get more details directly from the customers. The other thing we want to emphasize about the confirmation documents is remember, we look at the simple sales case. We say sometimes you may not get confirmation from the customers, right? So in that case, what can you do? And one of us answered, actually, you can go back to the transaction evidence, which could also provide alternative support to the balance of accounts receivable. So that's the answer for the case when confirmation is not obtainable. So in that case, so you can go to the transaction documents of invoicing and shipping. So go to the shipping documents and other supporting documents to verify the existence of the sales. On the other part, to close the loop, you should also look at the subsequent cash receipts. So the sales is down, and also the cash receipts maybe after the year end as expected, for example, in 20 days, in 30 days, in 60 days has been received accordingly, would provide another part of evidence also to the accounts receivable balance. So here so if confirmation is not doable, you could always look at alternative procedures from transactions, but you need to look at both sides, sales and also the subsequent cash receipts. And then, so the other confirmation also serve for existence rights obligation assertions. And because the yearly sales transactions tends to be quite simple, so yearly the evidence for the existence occurrence would also serve for the rights and obligation assertions, right? So we don't really focus on rights obligation assertions for sales cycle a lot. But for accuracy and valuation allocation assertion. So here, one main issue about this assertion is in addition to the sales or cash receipts, we should also look at the provision for doubtful debts. So in this sense, this age trial balance review would be very, very important. So what can you do in the age trial balance? So actually in the practice, in auditing the sales, we often use the age trial balance as the central documents for us. We obtain the preliminary age trial balance from the customer, from the clients. We can look at the total, and we can agree the totals with the sales book, with accounts receivable book, and also the cash receipts book, right? And also, from the totals, we can also do the calculation, do the summation of individual customers to the total accounts receivables. So by doing that, we also verify. So first, each customer got the right accounts receivable balance. And also, we check the calculation mathematical accuracy of the accounts receivables. Further from that, we look at the customer name and we search for some important or random customers to get our sample, and then to do the sample test for those sales transactions to provide further evidence to accounts receivables. And then coming to the valuation stage, especially for the provision for doubtful debts, we check when we are doing those inspections, we check if the past due dates are correctly recorded as 30, 60, or 90 days. So we check the details of the transaction and also details of the past due dates. Okay, and then what we can do is to look at the balance in each categories of the past due period, and then check the management regarding their provision policy, calculation policy. What you can do is do your own calculation to calculate the estimated provision for doubtful debts to see if it is consistent with the number customer provided. Okay, and also in terms of confirmation procedure, you can also select some customer to sending out your confirmation request. So that's what we say this document could be essential of your sales audit. Would provide you a lot of information about the sales evidence. Okay. And suppose around these accounts receivable documents, you have done so much work, collect so much evidence as a bunch. So if you need to point one type of audit procedure you have done, which one is a corresponding one? Reperforming, because in that procedure, actually you include mathematical check, you include confirmation, you include inspection, you include your professional judgment and calculation together, right? So you have done the reperforming of a trial balance. And as one of you raised before, so cutoff is often quite important and is a must-do process for sales and purchases. Usually we just take the sales sample for 1 or 2 weeks before the year end and 1 or 2 weeks after the year end, and do some test. And at the same time, you would also do the cutoff test for the cash receipts. So to do the cutoff test on both sales and cash receipts around the year end. Okay, so we are about finished. And for the final assertion we want to mention a bit is the presentation, disclosure, and the classifications. Because sometimes, so for example, one customer's account has been recorded to another customer's accounts. So this classification would be quite annoying to the customer and also will affect your trial balance, right? And also the credit policy. The other thing you want to notice in the presentation disclosure check is, so for the classification of accounts, so sometimes short-term receivables could be recorded as long-term receivable, or long-term receivables could be recorded as short-term receivables. And the details of short-term or long-term would also indicate the changes of the risk in this company. So you should also clearly identify which part is short-term, which part is long-term. For accounts receivables, the other important thing we want to mention is, so sometimes those accounts receivable accounts could be factored, could be sold by the company, right? So we have accounts receivable, but we can sell our accounts receivable to a debt collection company to get some quick cash. If the company has done that, do we still have the ownership to these accounts receivable? No. So for pledged or factored accounts receivables, so they need to disclose differently. They need to separately disclosed by the company. And also, there will be some special arrangements of accounts receivable. For example, discounted accounts receivables, the accounts receivable amount could be discounted. So these also need to be separately disclosed by the company. So all in all, those presentation requirements is to ensure the information users get a very clear picture about how much the company could be collected in the future, how long they can collect, and also how long they can get those money back, and how confident they know those money could get back to this company. Okay, so here we just list some examples for the tested details of transactions on this page, balances on this page. So please have a look of those examples to ensure for each of the assertion you know at least one example of substantive test. If you still feel confident, you need to think what are the collection of tests to serve each assertion to ensure sufficient appropriate evidence for this assertion. Give you an example. Let's say, okay. For example, for accuracy assertion, so if we just need one example, just do a mathematical calculation of sum up of all the sales invoices would be one correct example. But if you want to get the sufficient appropriate evidence for accuracy assertion, this wouldn't be sufficient, right? Because you also want, so in addition to the mathematical check, you also want to check the details of those underlying transaction documents. You also want to check the accuracy of the provision accounts. So without those, you also want to review the trial balance and also the follow-up procedures. Without those necessary steps, you get correct steps for the test, but you didn't get sufficient evidence for this assertion. So final words. So if we are getting the transaction detailed evidence on both directions, vouching and tracing, if we have checked the details for the selected sales samples, if we have done the cutoff test, if you have done the review to the trial balances, if you have already done the proper confirmation, and if you have evaluating the properties of the provision for doubtful debts, then basically for the sales cycle, you should have collected enough evidence. You just check do the test to find out the errors from your sample tests. If the errors are within the tolerant threshold, that means the account has been reasonable, fairly presented. If the errors is bigger than what you could expect, then you probably could make an interim conclusion. This account is not fairly presented. Then in that case, what you need to do is to contact the management to do the correction of those relevant accounts. After the correction, if the residual errors, if the errors the management do not want to correct are still there and also are still greater than your tolerant level, then you can make a conclusion this account is not properly represented. So would qualify your audit conclusion in this part. Okay, so thank you so much for your time. And so those are the tutorial work, but I'm not sure if next week we still have time, but please do the tutorial questions at home and keep your answers, and we are going to revisit them at least in week 10 or later on before the final exam. Thank you so much.
Thank you.